Imagine this. You're finally ready to buy a home. A $300,000 mortgage. You walk into the bank confident, excited. But overnight, while you were sleeping, 7 people in a building in Washington, D.C. quietly decided you'll pay an extra $300 every single month for the next 30 years. Not because your house changed, not because your salary changed, but because they changed the price of money itself. That's the unbelievable power of the Federal Reserve. The Fed. For beginners, the Fed is America's central bank. Its mission sounds simple: prevent another 1923 hyperinflation and never allow another 1929-style collapse. But the tool they use to control the entire economy? It's just one thing: interest rates. When that number goes up, every borrowing decision in your life becomes instantly more expensive. Your credit card, your car, and especially your home. Understanding this one mechanism can be the difference between saving tens of thousands and being financially crushed for decades. But here's the twist most people never learn. The Fed does not set your mortgage rate. They don't call your bank. They don't tell lenders what to charge. They control exactly one rate: the federal funds rate, the rate banks charge each other for overnight loans. Think of it like the bank's raw material cost. When the Fed raises that cost, banks simply pass the increase to you. And just like that, the entire financial system adjusts. It's a chain reaction that touches every corner of the economy. To understand the Fed, picture the economy as a powerful sports car. When it's speeding too fast, overheating, the Fed slams the brakes. That's inflation. When the engine is stalling, struggling to move, the Fed hits the gas. That's recession. Raise rates gives borrowing becomes painful, gives spending slows, gives prices come down. Cut rates gives money becomes cheap. If spending rises, gives the economy revives. Sounds clean and simple, but the real world is far messier. So why did we give so much power to a tiny group of unelected officials? Because before 1913, the U.S. economy was pure chaos. Bank failures everywhere, markets collapsing regularly. And in the panic of 1907, J.P. Morgan himself had to use his personal money to keep the whole country from falling apart. America needed a lender of last resort, a stabilizing force. So the Federal Reserve was born. 7 governors, appointed by the president, meeting 8 times a year, and every time they speak, global markets either explode or panic. But here's the controversy that never goes away. Is the Fed protecting the economy or engineering it for the benefit of the wealthy? Because when rates are low, the stock market and real estate skyrocket great if you already own assets. But when rates go up, businesses freeze, layoffs start, and the working class gets hit like a brick wall. The Fed has 2 impossible goals: maximum employment, stable prices at 2% inflation, but achieving both at the same time, practically impossible. Every decision they make creates winners and losers. So why does any of this matter to you? Because Fed decisions quietly shape your entire wealth-building journey. Saving. High rates equals savings accounts and CDs finally pay real money. Borrowing. Low rates equals the moment to buy a house, car, or make a big investment. Investing. Low rates gives stock market boom. High rates gives volatility and pullbacks. Money isn't fixed. Money isn't stable. Money is a policy choice. And the people who win the financial game are the ones who understand that choice. But don't fall for the myth that the Fed always gets it right. Their biggest catastrophe? The Great Depression. The economy was collapsing, and the Fed tightened money even further. Rates went up when they desperately needed to go down. It deepened the crisis and turned a terrible moment into a decade-long nightmare. Their second major failure? The 2008 financial crisis. Years of ultra-low rates pumped air into a massive housing bubble. And when it exploded, trillions vanished. Every Fed decision is a bet, a gamble. And the chips on the table? Your savings, your debt, your future. Today, the Fed controls the value of money with a pen. But before the Fed, money wasn't based on trust. It was backed by gold. In the next episode, we'll dive into the gold standard. Why money used to be tied to physical gold. Why we abandoned it. And what that decision means for the dollars in your pocket right now. If this changed how you think about debt, inflation, and your financial future, hit like, subscribe, and drop a comment. Do you trust the Fed to manage the economy?